The Dodgers make about $330 million a year from their TV deal. They're supposed to share about $150 million of that with the rest of the league. However, under current revenue sharing agreements and a unique little clause that happened as part of their sale, they only share about $65 million of those dollars. Now, what I would argue is worse is that small market teams receive over $100 million in revenue sharing, but many of them are pocketing those dollars instead of spending them on players to help field more competitive teams. I'm Mike Whitmire, co-founder and CEO of FloQast, inactive CPA. As an accountant, I love finding loopholes. It's kind of what we do. We find gaps in the system that no one else can see. And baseball's financial system, it has two major gaps that MLB teams have been exploiting for a few years now. In the last episode, I showed you why a salary cap is mathematically impossible. Today, I'm going to show you the two loopholes teams are using, one that pisses off owners and one that pisses off fans, and I'm going to explain exactly how we can close them. And we're also going to get very meta. There is a loophole within the loophole that my Dodgers are taking advantage of. I want to make sure I am impartial and neutral for this. So with that, I'm going to take off my hat. I'm going to put one that I bought on eBay. I found an MLB Players Association hat. So let's talk about how to field a more competitive team on the field. So before I can show you the loophole, I do really need you to understand regional sports networks and how they work compared to other leagues. So let's take a look at the NFL, for example. The NFL itself owns all of the media rights for every team in the league. And what that means is they can go to various networks and license out those rights. So we watch a whole lot of games on CBS, on Fox, now on Amazon, on Hulu. They all have rights to air NFL games. And those networks and those channels, what they do is they put up the expense and they pay the production cost and then monetize that through advertisements and commercials. They bear no risk in terms of the production expense of those games. Conversely, what regional sports networks do is a team will go out and license the rights to their games to one channel or one network. And then they are able to also own a part of that network through those negotiations. Now, what does that mean? What are the implications of that? If you own the network, you're bearing the production cost. And so there's risk associated with the expenses that go into producing a game. And I'll tell you, producing a baseball game is not cheap. You go to an average game, there are dozens, if not 100 cameramen all around the stadium recording the game. You have announcers, you have a studio, you have production staff. So there is risk that an MLB club is taking on. And with that, they have an equity stake in the regional sports network. So they're bearing some risk and they're getting a lot of reward with the equity value of that network. And I think that's very fair. I don't think equity ownership is something that should be shared with the players. However, we do need to make sure that an appropriate amount of revenue is being shared with the rest of the league. When you look at it today, of the 30 MLB teams, 17 of them own their own equity in their regional sports network. 13 teams do not own equity. How do we arrive at that place? When baseball was first created, every team owned their own media rights independently. If you can take those rights and create a regional sports network and basically drive more revenue than expenses, you're going to be profitable and you're going to keep your regional sports network alive and keep that going. 17 teams have been able to do that. However, you do have 13 small market teams where they have not been able to go out and license the rights to their games for enough money to cover the expenses that go into producing those games. I mean, if you're Rob Manfred, you're going to say, we can't have fans not watching the games of 13 teams. That's not good for our league. So MLB goes out, they acquire the rights, and they go ahead and produce those games and bear the expense to make sure that the fans are able to watch the games from those 13 teams. Now, this creates a really interesting opportunity where we can start to bring more teams into the fold. And if they do not own a regional sports network, we're going to be able to license games very differently. And as a result, share revenue very differently as well. So the money flows through RSNs in two ways. First, a network or a carrier is going to pay the team for the rights to air their games. I'm going to use the Dodgers contract as an example here. So the Dodgers license the rights to their games to Spectrum. Now Spectrum has the exclusive rights to air Dodger games. That exclusivity is why they're willing to pay so much for the rights to watch the Dodgers. As a Dodger fan, I can tell you, if I didn't have to watch their games on Spectrum and I could watch them on MLB TV, I would have already cut the cord. So that's the rights fee is what Spectrum is paying to the Dodgers. That's that $330 million a year, which is hyper valuable because it gives them a monopoly on Dodger games. Then you have the carriage fees. The carriage fees are what fans pay for the right to watch that. And those carriage fees are not subject to revenue sharing. Teams can manipulate this number and they can decide which bucket it goes into because there is not a lot of transparency on the financial side. Now, the regional sports network and the Dodgers get to decide what percentage of that fee is actually related to a Dodger game. If I say it's a low amount of that, and I'm getting a high carriage fee, that means my profitability is significantly higher, which makes the value of that regional sports network higher. Conversely, if for some reason I wanted to reduce the value of that entity, I would go ahead and say the carriage fee represents 80% of the value of that thing that Mike pays every single month. As such, our profitability is lower. We don't have to pay as many taxes, we don't have to share as much revenue, all that good stuff goes into it. All of that is then very subjective, and the accountants and the auditors come in and need to make sure those numbers are accurate. However, that is very difficult because there is a serious lack of financial transparency across all of MLB. Unfortunately, the Dodgers do have a loophole within the loopholes, and I want to be hyper transparent about that. Back when the team was a simple asset in the middle of a divorce between the McCourts, we were in a really tough position, and MLB wanted the team sold so that we had better ownership and a better product on the field. Jamie and Frank McCourt were about to go to bankruptcy court, and if you go to bankruptcy court, the financials for that asset are opened up and made public so that the lawyers can agree on the fair market value of it and figure out how much money everybody should get through this wonderful divorce. So what did MLB do to try to accelerate the sale of this so it wouldn't have to go to court? They agreed to cap the amount of revenue that would have to be shared from any TV rights deals. When the transaction occurred, that cap was $84 million. So what that means is the Dodgers in year one only had to pay 48% of $84 million instead of paying 48% of the $335 million that they actually make per year from the contract. That is very unfair. That is not the same revenue sharing that everyone has to adhere to. In fact, the Dodgers, as part of the most recent round of negotiations, agreed in goodwill to go ahead and share additional amounts of that money, and they increased the cap from $84 million to $130 million. Admittedly, they are still not sharing 48% of the $330 million. However, it was very nice of them to open up and pay on the $130 million instead. So I just want to take a step back and make it very clear, we shouldn't all be pissed at the Dodgers about this contract existing, and maybe all of you can now feel the pain that we as Dodger fans have felt as a result of the McCourts owning this team. They were terrible, and I've never been happier to move on from them and have the Guggenheim Group running this organization. Now, hopefully you've been following the whole series, especially our MLB Econ 101 episode, where I showed you that the Dodgers make a total of $750 million a year in revenue versus the A's, who are only making a total of $250 million in revenue. Regional sports networks are the biggest driver of that income inequality. All that said, there's over $100 million in revenue that is being shared with the small market teams. They are supposed to spend that money to put a better product on the field for their fans. However, I'm here to argue that's not necessarily what's happening. Now, if you're in the baseball world, you've probably seen this chart going around. It's really well laid out by Forbes here. It shows you all the MLB teams. It lists descending order their total revenue. It shows you what their payroll is, as well as their luxury tax. And then it shows you what percentage of their revenue is being spent on payroll. If you look all the way at the top there, the New York Mets spend about 90% of their revenue on payroll, which is awesome. As a fan, you must love that. If you kick to the bottom, you'll see the Marlins are only spending 27% of their revenue on payroll. Now, I will say it's a little unfair to judge the small market teams here because there are heavy fixed expenses with running teams. So it is unreasonable to expect somebody like the Marlins to spend 90% of their money on payroll because they will absolutely lose money because it costs money to run a stadium, have a front office, all that good stuff. So there is a grain of salt to be taken as we look at this chart, but it is directionally accurate and shows us how much these teams are spending on their players. As part of the last collective bargaining agreement, teams agreed that they would spend at least 150% of their revenue sharing in an effort to improve on-field performance. As a fan, the way I read that is my payroll is going to be 150% of my revenue sharing, which means I get a better product on the field tomorrow. I go to a game, I'm going to watch them, they're going to be a better club, higher chance of winning. That's how I interpret it. MLB teams do not necessarily interpret it that way. They make arguments like, if we invest in facilities at our spring training camp, that's going to help players develop faster, which is going to ultimately lead to a better on-field performance. Now, the motivation here, if I'm an owner, is I want to take this money and invest in capital improvements that increase the value of my organization. If I'm the Rays, I would much rather take my revenue sharing amount and plow it into building a much better spring training facility. Because what am I going to get from that? I'm going to get a higher value of my organization. I'm going to be able to charge more for spring training tickets. Yes, I'm going to have better facilities for my players, but that doesn't really increase the value of my organization necessarily. So I can pick and choose where I want to invest based on the future promise of a better product on the field. I do not think that hits the spirit of this clause. I think that spending 150% of it should be for players on the field. And the rule around this, the way it's checked, is that MLBPA is able to file a grievance against any team that is not spending enough. So the Marlins are under fire from the MLBPA because they had a payroll of only $68 million versus the $150 they were supposed to spend. As a fan, I I would assume that spending money to improve the on-field performance means I'm paying players more to get them to the field and play baseball today, tomorrow, and the rest of the season. So here's a quote from one of their owners, Bruce Sherman. He said, "We made a significant investment, not only in front office staff and technology, but we've also done a tremendous amount to improve the ability of the players to perform. We're putting a tremendous amount of resources into Loan Depot. You haven't seen any of this yet, but we're going to have the second biggest weight training facility in all of baseball for our players. Our training doesn't stop at the major league level. We've added levels into the organization that we've never had before." So what does that mean? That means that in a single year, they spent $80 million to improve facilities and increase front office salaries. I can see how you can squint and make an argument that one day that's going to improve on-field performance. But again, as a fan, my expectation is not that hopefully at some point in the future I get to go watch a great product on the field. My hope is that tomorrow I get to go watch my team be competitive and compete against the big market teams like the Dodgers and the Yankees. So this is all being manipulated. I think this is a massive loophole that has to be closed, and it's very simple. Remove the word spirit from this entire thing and just say it has to be spent on payroll. So the small market loophole, really easy to fix, just require the teams to spend it on salary that's on the field. The big market teams, that one's much more challenging and will take a longer period of time. One of the interesting things about this bargaining agreement is we happen to have a new and emerging form of revenue that Manfred might be able to leverage to convince teams to share more of their TV rights. That form of revenue is gambling, which has a whole lot of nuances around it, but it presents a really interesting opportunity. We'll cover that in our next episode. Make sure you like and subscribe so you don't miss it.